Join us now to talk about where the Fed goes from here in light of the rising bond yields. We're seeing Joe Lavorgna, chief economist at SMBC Nikko Securities America, and Betsey Stevenson, professor of public policy economics at the University of Michigan and a former chief economist at the U.S. Labor Department. Betsey, I'll just start with you, and then I'll get to Lavorgna. But do you agree with Chair Powell that there are not necessarily at this point real signs of weakness in the U.S. economy?
You know, I feel like we're in a delicate balance of words here. The U.S. economy is clearly extremely resilient. That was a word that Powell used, and I would agree 100% with that. You just said no signs of weakness. I would disagree with that. I think there are some signs of things slowing or at least normalizing. And actually, I think Chair Powell acknowledged that as well. You know, the quit rate has come down. The outsized wage gains people were getting from changing jobs has come back down, so that you actually always get a bigger wage increase when you change employers than when you stay with the same employer on average. But now what we're seeing is the difference between those two is back in sort of pre-pandemic normal territory. So that normalization is signs of slowing. But I think what he's worried about is it's stronger growth than you would expect at a time where you're trying to bring inflation down. But I think, on the other hand, we're seeing inflation continuing to come down. And I think it really comes down to the fact that the models are dealing with really uncharted territory. Women behave differently than men in terms of return to work coming out of a recession. And I think that's allowed supply to expand a lot faster than a lot of people expected. And that's why we've been able to bring inflation from 9% to 3% while keeping unemployment below 4%. That's not in our models because we've never done that before.
Joe, he said, even taking lags into account, that there may be more tightening effect from what they've already done, and they haven't done anything in a couple of months, 3, whatever it's been, and that the long end has really been going up.
Yeah.
So you got the possible lag effects, and you got the market tightening itself, and he still says, are we in restrictive zone?
Well,
and he
it's
says,
double
no,
talk.
we're not in a restrictive. You think we've been in a restrictive zone for months already?
Well, the yield curve has been inverted, and look, manufacturing, if you look at the ISM, I think has been below 50 for 11 straight months. Residential investment, housing's in recession. So there's definitely signs of weakness, and those are the two sectors that typically tell you where the broader economy is going. He's giving us a bit of doublespeak because he's saying they may not be too tight, but that there's restriction in the pipeline. What I come back to is how resilient do you think today's economy is now relative to 2006, or even right after the financial crisis, and where's underlying productivity? I don't see this economy, Joe, as being very dynamic. If it was, consumer confidence readings wouldn't be near recession readings. And I know GDP is supposed to be 5%. Not unusual to get these pops in output right before the economy rolls over. But this doesn't feel to me like it's a 5% economy by any means.